What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of S&P Global, the benchmark rating and financial analytics company, see where shares are trading at today, and if this presents a good buying opportunity for investors long term. As always, this video is not investment or financial advice, and it's solely for entertainment purposes. All values that you'll see within this video are as of market close on May 19th, 2026. So let's dive right in here to the past 12-month price chart for S&P Global shares. You can see that within that time frame, shareholders received a negative 21.4% return, comparing that to the benchmark of 23%. That does indicate a one-year relative underperformance of shares of S&P Global to the benchmark of negative 44.4%. Quite remarkable. On a year-to-date, 1 month and 1 week basis, shares have also underperformed the benchmark significantly. You can see in that price chart there above, S&P Global shares have had a significant decline really since February. February, there was a big drop off when they reported their Q1 earnings and they posted poor guidance. They recently reported and beat on their earnings significantly. So I do believe that February sell-off is overblown and shares are trading still near their 52-week low and significantly below their 50-day moving average you see there in the orange line. And having a relative strength index below 20 is indicating it is an oversold name. We've had a significant spread between that 50-day and 200-day moving average. That is that orange line there. Everything on a technical basis is indicating oversold. Again, let's see long term how that transpires, but really here the earnings per share is what I want to point your attention to. Again, nothing crazy here. You're seeing 10% year over year, 11% year over year earnings per share growth through 25, 26, and 27. Nothing that's going to blow you out of the water, but this is a very steady Eddie business that will have reoccurring cash flows and inflation hedged revenue as well. With those projections, we should continue to see the synergies of their acquisition in 2022, and we'll see a lot of these margin compressions and earnings per share decreasing in 2022 because of a large acquisition. We should continue to see those earnings per share growing and margins growing as well. You can see sales growing 8.5% over the past 12 months, outperforming handsomely the industry and the benchmark. But what I was mentioning about that 2022 acquisition, you can see there the gross margins, EBITDA margins, net margins, and so forth in those 10-year trends. In 2022, you see a significant decline in all these margins. That just essentially happens when you're acquiring another company, almost at the same scale there, and having those synergies and time. Essentially, you have to give the company time to have those synergies, those cost cuts, to have those expanded margins. Wish it's turnkey where you purchase a company and in a year or so your margins are at or greater than what they were previous to the acquisition. But still, you're looking at phenomenal margins here that are almost double both the industry and benchmark averages at almost 63% on a gross margin basis, net margins of 30+%, return on equities of 14.8%, almost in line with the industry and higher than the benchmark. Solid fundamentals there, and we should continue to see that growth in the business through the synergies, but also a spin-off of certain businesses that I'll touch on later on in the video. But when we look at those valuation metrics as well, price to sales, very cheap at 7.7, price to book as well for the underlying growth that you're seeing in the business and should continue to see long term. And you look at that forward PE of less than 20 at a 19.9. That is at its 5 and 10-year low. Quite remarkable there that you're getting such a great company at such a cheap cost today. And you can see the 20+ analysts that cover the name. There are no sell ratings with an average price target of $533.95, implying a 30+% return in shares if they hit their price target on average, which is quite remarkable when you see the most pessimistic analysts having a almost 17% upside in the name, with the most bullish having a 40+% return in the name. You do see that decline in target prices, that is that dotted line, coinciding with share price declines as well in February because of that weak guidance. You do see a little bit of a revision upwards. S&P Global reported Q2 a few weeks back. A couple analysts have raised their price targets, but there is still a very wide discrepancy between share prices and what institutional money believes is a fair value of the company. That discrepancy has been there for the past 12 months, I believe for the past 3 years as well. Quite insane to see such a spread in share prices to institutional target prices there. And this is what I was talking about on a 5-year basis. Almost all these metrics are at their lows. You're getting such a phenomenal company, I believe, in its history as well. I was looking at the 5 and 10-year valuation summaries, and they're significantly below the averages and almost at their 5-year low. The 5-year low on a forward PE, just to put this into perspective, was at 19.1. It's currently at a 19.9. You did see a little bit of a bounce in the share prices, but a 5-year average of 28.2, that is almost 10 points lower on a forward PE basis. Currently, shares are trading very, very cheap. And this is his peer group analysis. Really what you want to compare here is S&P Global and Moody's. On all these metrics here, S&P Global is trading at a cheaper valuation with higher growth. Long term, I don't really like to compare it to the other names. Moody's and S&P Global really do have parallel businesses, I will say. But when you look at those margins, they're also very similar. Gross margins for Moody's at 68.2, compare that to S&P Global at 62.8. Again, I'll touch on this in the next snippet, but you will see the drop off of margins, and we saw that in the previous snippets there in 2022 after their acquisition. But they're starting to trend in the right direction and recoup those margins that essentially have been compressed for the past almost 4 years now, and should in the next year or so surpass the margins of Moody Corporation. Again, time will tell. Moody's hasn't had the same acquisition size as S&P Global. That has made their margins continue to be higher, expanded, and having solid returns on equity and invested capital in Moody's relative to S&P Global. But we are starting to see finally a good trend in the right direction for S&P Global shares and the fundamental business. And these are those profitability ratios that I was talking about. You can see that steep drop off there from that acquisition. Look at those gross margins, for example, in December of 2021 at a 71.4, currently at an almost 63. We have seen that recuperation of margins and should, at least through 2026 and 2027, have that come back to where it was in 2021, and hopefully continuing to expand those margins long term, just with the nature of the business and the spin-off that they're having later on this year that I'll touch on later on. But you see those prior to the acquisition, phenomenal returns on assets, equity, total capital, invested capital. Look at that equity number there in 2020 at 473.5%, currently at a 14. 14 is solid numbers by any standards, but we've had that acquisition compress a lot of these values and finally starting to see through their synergies and their cost cutting and the vertical integration of the two businesses. We are starting to see those returns come up in a lot of these profitability ratios. So here's that financial statement. We're looking at phenomenal 5 and 10-year compounded annual growth rate numbers. Look at that, sales and revenue of 15.6% on a 5-year CAGR, 11.2% on a 10-year CAGR. Operating income looking phenomenal there. We're looking at all double-digit returns on a 5 and 10-year compounded annual growth rate. Beautiful to see. You see that earnings per share on a 10-year basis at 13.5, 5-year at 6.7. That does just reflect that acquisition 2022. Prior to that, you were seeing very solid earnings per share. But again, we are starting to see that trend in the right direction. And in this channel here, we look at long-term investing. And I do believe this will pay dividends long-term based on the synergies and the vertical integration of these two companies post-acquisition, almost 4 years and counting. This is the various segments of S&P Global where they derive a lot of their revenue. This is beautiful to see because we are seeing the ratings and the market intelligence making up almost 2/3 of the revenue base for S&P Global. These are very high margin businesses. They're spinning off the low margin businesses of their automotive, like Carfax and so forth. We'll touch on that in the next snippet, but we are seeing these trends in the right direction. And AI was a threat. And again, I'll touch on this later on in the video, but S&P Global has access to proprietary data. You think of a lot of the companies that say you work for. I'll use banks as an example. Banks can't even use Gemini, Microsoft Copilot, Claude, or any OpenAI product because these management and security teams are worried about data breaches and releasing confidential information to these large language models and AI, where S&P Global already has that consumer base, already has access to that proprietary information, and they can use AI to actually become a more efficient business, push out more accurate ratings, and charge more and have a growth in their consumer base as well. So I believe AI is a benefactor for this company, not a detractor. So I believe it's important here for us to touch on a few positives that I've been talking about in this video. I'll start off with the planned mobility division spinoff. This has been a major catalyst for the stock, which is scheduled for mid 2026. They're spinning off their mobility division, which includes businesses like Carfax, I mentioned earlier. Investors expect this to re-rate the remaining company, allowing it to focus on higher margin core segments such as that ratings, market intelligence, commodity insights, and indices, which I just want to mention on an operating margin basis, all exceed 50+%. S&P Global recently reported a strong Q1 2026 with an earnings per share of $4.97. That did beat the analyst estimates. Revenue grew by 10.4% year over year, and management raised its full year 2026 earnings per share guidance, reflecting robust operational health. This is a stark difference from the February report that caused that significant sell-off that we saw in price charts. The strong business model, I believe, is a big catalyst for S&P Global. They act as essentially a toll booth on global capital markets. They benefit from recurring, sticky revenue streams. It is a dominant player in the credit ratings and benchmark infrastructure space, providing significant pricing power and resilience even in fluctuating macro and microeconomic environments. As I mentioned, they are insulated from that AI threat, from that proprietary data that they have. And something that we do like to see is the company buying back its shares. The company did demonstrate a commitment to returning capital to shareholders in its most recent report. Hear this number out, guys. They plan a $13.85 billion share buyback program. And additionally, notable insiders have been buying. Example will be the CEO recently purchasing a significant amount of shares off these dips in February. And prices were higher in February than they are now. So I can only imagine insiders are purchasing more. And this will be a great time for investors to purchase the name, as the company itself is purchasing shares at its almost 52-week low and should have a solid return on those investments there. Those are just a few catalysts for the name. Long term, I do believe personally that investors will be rewarded handsomely for everything that S&P Global is doing fundamentally and operationally, and that does transpire long term into positive share price performance. But hey, who knows? Time will tell if this will be a solid investment. Please do hit that like and subscribe button, guys. It means a lot to me. And stay tuned for the next video.